So I'm gonna share my screen and I'll let Stefan let everyone in. Okay, hello everyone, and welcome to the ninth edition of our regional alumni talk presented to you by AIESEC Alumni Asia Pacific and AIESEC. We were very excited for this one because we have a really cool speaker. Personally, I'm very excited for this as well. We've had a couple of conversations, but I'll tell you more about Mr. Vikram Gandhi in a little. First things first, of course, I wanted to welcome everyone, and I'll hand it over to Prayog, who is from AIESEC, and of course, this is co-managed or co-branded by AIESEC Alumni Asia Pacific and AIESEC itself. So I'll let Prayog say a couple of words before we move on.
Hello, thank you, Gaurav. Welcome everyone once again. I'm Prayog, currently the regional manager of AIESEC in Asia Pacific, and we are really happy to bring this to all of you. I see some fellow AIESECers as well in this talk, and I'm really happy for all the initiatives we are doing with AIESEC Alumni Asia Pacific, and including this talk. So really happy and looking forward for this talk as well. Gaurav, back to you.
Awesome. Thank you so much. Thank you so much, Prayog. Of course, a couple of expectations from everyone. Be engaged and participate as enthusiastically as you can. Always encourage you to keep your camera on so that we can have some kind of interaction in the virtual world. Mute yourself when you're not talking and unmute yourself when you need to. Ask anything. The Q&A will be at the end of the presentation. This will be slightly shorter presentation than we've had previously, but I'll tell you guys the agenda. So of course, we're going to the introduction right now. Then Mr. Vikram Gandhi will take over and have his presentation on sustainable investing. I'll open a link for feedback. If any of you want to give feedback, of course, remember this is very valuable to us. And then we'll have the Q&A space and of course, some housekeeping things as well. Awesome. So before I hand it over to Mr. Vikram Gandhi, let me tell you guys a little about him. I'll give you guys like my personal interactions as well as, of course, his CV is fantastic. Nonetheless, my personal interactions with him, although haven't been like too many, I think it's been very positive. And when you hear him speak, it's always like this really cool, like confident energy that he brings to the room. He's also very efficient as a person. Like a 30-minute meeting can be done in 10 minutes with him. So props to you on that. Of course, his CV is fantastic, of which I'll tell you guys a little bit. He's a senior lecturer at Harvard Business School in the entrepreneurial management unit. He has developed and teaches a new course, investing, risk, return, and impact, which we will hear about a little about today. He also teaches the entrepreneurial manager and field global immersion in the MBA program, as well as various executive education programs. He's a visiting faculty member of the Schwarzman College and the Tsinghua University in Beijing. He's also a member of the Impact Co-Lab Laboratory on research in the area of impact investing. Mr. Gandhi is also a founder of Asha Impact, an impact investing platform, and is a senior advisor to the Canada Pension Plan Investment Board. He's also been a member of the Young Presidents Organization since 1997 and has been part of the New York, Hong Kong, and Mumbai chapters. So, as we all ISECers have learned, a very, very global citizen in every way possible. He spent 23 years in investment banking at Morgan Stanley and Credit Suisse, which are fantastically big and reputable firms. He holds an MBA from the Harvard Business School, where he was a Baker Scholar, and has a BCom with high distinction from the University of Mumbai, where he also is a qualified chartered accountant. So fantastic CV, to say the least. But without boring any of you guys, with me, I'll hand it over to Mr. Gandhi and let him take over. Mr. Gandhi, over to you.
Great. Well, thank you so much, Gaurav, for that kind introduction. And thank you for David and the Alumni Association and for AIESEC and you and your team to have me here. When I got the call to do this, I was absolutely thrilled that I was given the opportunity. AIESEC has played a really important role in my life. I remember back in the early 80s with a bunch of other people in dorm rooms in Mumbai, as well as at IIT Delhi and Delhi University, is what created the genesis of AIESEC India. This is 81. And then, I've had a kind of a fantastic experience at AIESEC, both in setting up AIESEC India, being the NCP, and then having the privilege to basically having the privilege to become AIESEC International President, which at that time AIESEC International was in Brussels. So, I think there was so much foundational support and foundation that was created at AIESEC that I'm eternally grateful for the organization for that. And not just the managerial skills, but there's so many other things that you learn about at AIESEC at such a young age, dealing and marketing and selling and dealing with finances and fundraising, and equally important, like how to party and party hard. So that's been actually a big learning experience for me as well. And so when I was given the opportunity to actually speak with all of you, I thought, like, what would be relevant in terms of what I'm doing, as well as what's kind of very relevant in the world today, just given where the world is headed in terms of climate issues, social issues, broader governance issues, geopolitical issues, etc.
Nach dem Talk Asia Pacific heute noch.
Oh, actually, if everyone can put yourself on mute, please, that'll be great. So the essential part that I wanted to kind of cover today was really what I teach at Harvard. It's called Sustainable Investing, or Investing Risk, Return, and Impact. And this is a course which I developed over the last, 3-4 years back, and have been teaching it now for the last 3 years. And it's really a big focus area of the business school at Harvard, plus other business schools, but also just generally at corporations, at investors. More and more customers and employees are focused on this. And so I thought I'd just give you, what I teach, over 28, 80-minute sessions at HBS over kind of a full semester between January and May. I just finished teaching this course last week. Just to give you a little synopsis of that, I'll probably speak for about 20, 25 minutes. And then essentially have a dialogue and discussion with you. I mean, it'll be great to interact. I see some old friends on the chat here, which is just wonderful to see. So sustainable investing, and just to kind of set the stage here for a second as to what is impact investing, what is ESG. Some of you all may be very familiar with that, but I want to set the stage as to why is this important now, and then go into as to what role, since this is more from an investing angle, like what role are investors playing and how are they thinking about these issues. So impact investments, essentially, you can make the argument that all investments are impact in some shape or form because they create jobs or they create economic activity. But I think the way to distinguish impact investments are, first of all, they're investments. It's not charity, it's investing, looking for returns. But the key difference is the intention, that when an investor is investing, they have the intention to generate positive and measurable. So it's not just positive, but it's measured, and it's part of a metric or metrics, just like financial metrics, on measuring the social and environmental impact in addition to the financial return. So I think the key distinction here is both the intentionality of it, but also the fact that you're actually measuring it and holding managements and boards that you invest in accountable for it. Another kind of lens on the sustainable side is basically ESG. And just for those, and I'm sure this has now become a big buzzword, but essentially it's like saying, in addition to the financial analysis, or integrating into the financial analysis, is environmental issues, social issues, income inequality, gender inequality, a variety of social issues, that racial inequality that exists in our world today, and how do you kind of factor that into making good investments. And then governance, which is, ultimately, if you look at over a long period of time, good governance can create significant value, and bad governance can destroy value. And in fact, there are enough studies that show that actually a lot of bankruptcies, a lot of business failures are driven largely to extent of bad governance. So it's creating impact with intentionality, and then factoring in environmental, social, and governance issues. And that's what I would call sustainable investing is, bringing all these things, not as a side issue. It was, let's say, 3-4 years ago, but now it's becoming integrated into mainstream investing. And so the question really is, like, what's driving this? Like, why is this happening right now? First of all, just so you know, that about $40 trillion worth of assets globally, equity assets and fixed income assets, or equity assets, this is predominantly, have some sort of ESG overlay on them. That is, that about 25% of all professionally managed assets, which this number was probably more like 5 or 10% only 5 years ago, are incorporating environmental, social, governance impact issues into their investment process. And this number is only growing. It's growing significantly higher than general assets under management. And our prediction at HBS is that within 3-4 years, this number will be closer to 50%. Just to give you an idea, 40 trillion, because this is a global number, 40 trillion is basically the size of the US stock market. So it's a very significant number, and it's becoming a very fundamental issue in discussions at large investors, as well as at boardrooms and in the C-suite and companies. And so what's driving this? The times clearly are changing. I mean, if I just look at the generational issues, and I think we have a whole mix of people on this board. I'm a baby boomer, David, and I see Mike Sutton and all that, who's an old friend. are all baby boomers. And a lot of you who are still at AIESEC or just like recently graduated are like the millennial and then the Gen Z, et cetera. But we've done various studies, and it shows like, you know, if you look at the baby boomers, like my generation, essentially only about 22% or so were kind of interested in impact investing and thought it mattered. It was all just about financial returns and it doesn't really matter. Then you go to Gen X, which essentially are, you know, between 30 and 40 kind of age group or 45 age group, is that it goes up. But then you go to the millennials, and if you did Gen Z, which is even the younger group, this number is significantly higher. And so it's essentially saying that the younger generation are just much more anxious and much more kind of focused on saying look, we need to do good, but we need to do while we make money. It's not a kind of mutually exclusive thing. And the why this is relevant is that if you look at over the next couple of decades, what $40 trillion worth, like the size of the US market, is going to be transferred, you know, to the younger generation, to the millennials and the Gen Zs of the world, who have a very different perspective on investing and what kind of needs to happen as part of the investment process. So that's one kind of driver of this, which is generational shift and asset ownership shift. The other issue is that, you know, whether you believe the UN or not, but essentially the United Nations has created this, which some of you must be familiar with, is these UN sustainable goals, which really has kind of become the North Star for a lot of government spending, nonprofit spending, and now increasingly so investments, which is saying that, you know, we do have some serious problems. I mean, I don't want to get into the climate issue, but clearly it's a massive problem and this world could kind of disappear within 30, 40 years or longer, but be in deep trouble if we actually don't deal with this issue. And there's 17 of these. There are obviously big societal issues, which are also listed here. And so the question is, how do you meet these goals? And the need to actually meet these goals and kind of deal with these ESG issues that exist in this world is about $5 to $7 trillion. That's an estimate of the IMF and the World Bank, that this amount of money is needed to invest to kind of deal with these 17 issues. And if you look at government spending and nonprofit and public spending that way, is that it is just completely insufficient to kind of meet this 5.7 trillion. The best estimate is that about 2 to 3 trillion deficit will exist. So the government may be spending half this amount and philanthropic capital, but there's a big hole. And so this hole really needs to be filled up with private commercial capital. And that's what's another big issue driving. And I mean, just to give you a perspective, like the US is kind of the biggest charitable kind of country in the world, to some extent driven by its tax kind of policy. But the entire spending of US on charitable giving is $800 billion per year, right? And that's for everything. So you cut back and look at these 17 things, it's significantly less than that. So the reason I say this is there's a big demand, there's a big problem in this world, and philanthropic and government spending is just not enough to kind of meet it. So you have to really figure out as to how commercial capital can deal with these issues of reducing poverty, getting education, gender equality, clean energy, et cetera, et cetera. This coming year, the World Economic Forum was virtual, but I had the opportunity in kind of go to Davos last year before the pandemic broke out. And just to give you an idea as to, and it's only got more, you know, increased momentum in the thing, that of the 150 business sessions over those 3 days, more than 2/3 were dedicated to climate issues and stakeholder capitalism, which is that not just shareholders are critical, but you need to look at customers, employees, suppliers, and the broader community at large in terms of your activities. And then what is the role of investors? Big push towards, you know, how can investors really kind of allocate capital to deal with these climate issues, which are kind of, and I'll tell you, COVID-19 actually has accelerated this process because people have realized, you know, COVID-19 came and hit us in the face very quickly. It kind of co-opted everyone to, you know, just it's amazing. I mean, even though the rollout of vaccines may be an issue at various parts of the world, but the fact to create a vaccine in such a short period of time through public-private partnerships is actually amazing. But it brought people together because it was an immediate problem which had to be dealt with. The problem with climate is that it's a classic tragedy of the commons issue, which is, or a collective action issue, which is that it's everybody's problem, but it's no one's problem right now. And so therefore, to actually, you know, deal with things which have an impact 10, 20, 30 years from now, where there's no immediate urgency or perceived urgency is a big issue in terms of bringing people together. And so COVID-19 has accelerated this because people have realized in terms of the impact, the negative impacts of COVID-19, hitting the lower ends of the population significantly higher, destroying economic activity, et cetera, is that, if this COVID-19 can do this, just think about what climate change can do. You can't vaccinate against climate change. You can't have masks and social distancing to deal with climate change. It's a permanent change. And so I think as a result of COVID, the focus on climate, and I think the US change in administration has also helped because it brings the largest economy into the world back in the fray of this. So that's kind of just a little backdrop on that. The second is that, to actually allocate capital and make sensible decisions, you actually need standardized metrics. So there's a big body of work going on in that. And then the third is that, look, yes, shareholder value creation is important, but the question is, over what time period? And a lot of investors, the pension plans, the insurance companies, like I talked about family offices, which are big pools of capital, which have a multi-generational focus, is that they're long-term. And you have this, and I'll get into a few studies here, which show that long-term value creation only happens if you focus on all your stakeholders. You just can't be focused on short-term profitability and short-term margins and cash flow. You got to be thinking long-term, and that's where most investors, or more and more investors, are kind of focused on this. So what is the opportunity? So I talked about, like, here's the issues, here's the thing, but what's the opportunity? So one way to think about the opportunity as an investor or as an operator of a business is that, let's look at this chart, and you say, look, you have $1 to spend, and you can just focus on financial returns. So that's on this axis. On the other axis is social returns, that you can spend that dollar just purely on social returns, like philanthropy or government spending, where the return is a social return as opposed to any financial return. And most people historically have thought these are very mutually exclusive, they can't be brought together, which is where there's a big shift in thinking here in the last 3 or 4 years, or a little longer. And that, therefore, if you look at this curve here, which I'm like drawing the cursor on, that for every kind of increase in social return, you basically, the original thought was you need to have sacrifice financial return, or for every decrease in financial return, you may get some social return. So therefore, they're kind of mutually exclusive and not synergistic. And I think that's kind of wrong. I mean, I think it's now proven that it's wrong, and that you can actually generate financial and social returns. And so the real question is, can we bend this curve? I mean, the best place to be would be, where I'm putting the cursor right now, that you can maximize social returns and not give up any financial return, that you want to be over here. So the question is really, can we bend this curve? That is, move it in such a way that, you incorporate social return, ESG issues, impact issues, without sacrificing financial return. And that kind of leads us to, like, okay, then what are the objectives of investors? And I think this is for you all to personally reflect on, because there are two very distinct and somewhat kind of, could be combined, but they're somewhat distinct. So what I would call the differences between values and value. So in values is that if you're personally looking at, and a lot of family offices, et cetera, who don't have these so-called fiduciary obligations, that should I reflect my values in my investment portfolio? I don't want to invest in alcohol stocks. I don't want to invest in tobacco stocks. I don't want to invest in stocks which are destroying the world or the climate, are having a negative impact on climate due to emissions. But you could potentially sacrifice financial returns as a result of that by reducing your portfolio kind of lens. So should I reflect by, and if so, if you decide to do that, how do I do it? Do I need to sacrifice financial returns to do so? And I'll get into some studies about that, as I said. And so therefore, this is really applicable to family offices and other discretionary pools of capital, where it's your money, you can do whatever you want with it. And so that's one. And I will say, don't underestimate what family offices and personal wealth can do, because family offices as a group are as big as the pension plans and some of the insurance companies. So there's a huge amount of money out there. The other issue is value, is that if you are a long-term shareholder, how do I incorporate, I mean, if I have a 15, 20-year time horizon, if I don't incorporate climate and societal and good governance into my investment process, am I actually doing good risk analysis? And so therefore, I mean, like if I'm investing in real estate, coastal real estate, and I don't factor in climate, I could, those buildings or commercial real estate or whatever could get wiped out because of rising sea levels, as an example. So how do I incorporate impact and ESG into my valuation analysis? So a lot of pension plans, et cetera, are very focused on this. The second piece is that, okay, there's a risk analysis perspective, but is there alpha? Means, can I generate returns beyond the market because I can identify companies who are doing this well and therefore will create more shareholder value over time? The other is that, look, a lot of managements have their head in the sand, and I think more and more shareholders are getting more activist, but a lot of them have had their head in the sand. This is not my issue. I'm focused on the next 90 days profit, the quarterly earnings and all that. And therefore, I'm not going to do anything about it. And so large pools of capital are actually trying to figure out, how do I, as a big shareholder, and particularly the large three firms, between BlackRock, State Street, and Vanguard, which own a lot of the passive investing platforms, basically are, they own the market. They basically own 30% of the stock market globally. So and they're long-term investors because they are index investors, so they can't really sell if they don't like a company. So therefore, how do I influence management? And that's why, as I said, this is applicable to fiduciary pools of capital. If the manager of a big pension plan says, I don't like X, Y, and Z, and tries to reflect their values, they may be violating some fiduciary obligations. But if you think about it and say, look, I'm incorporating ESG and impact because it's better risk management and potentially could generate better returns, that's a whole different ballgame. And there are lots of investors who are trying to do that. So I just want to give you this distinction between values and value, because I think a lot of this factors into how you kind of make investment decisions. So just to give you a quick thing, this is a course that we teach at HBS. As I said, it's over 28 classes. We have an introductory thing. We do a whole bunch of private markets as to how family offices and others and big PE funds, et cetera, like TPG and Blackstone and KKR and others, and then smaller funds, which are very focused purely on impact investing, are bringing that in. Impact measurement and metrics, which is the third kind of bucket there, is a critical piece, because if you can't really measure something, you can't manage to it or you can't invest through it. So this push towards creating standardized metrics is a big push. For example, you can compare investments across from a financial thing because you look at ROE, ROA, IRR, et cetera. Right now, there's not enough consistent disclosure across companies to compare their impact and ESG performance, but there's a lot of progress being made on that. Then we have a big piece on public markets, because by definition, the size of public markets are huge, and therefore the influence on dealing with these issues is very big as well. So I'll just, so we have sustainable investment strategies, both in the private and the public markets, and how you kind of implement that in the private markets is the intentionality. And then I would say there's the returns continuum, which I'll get into in a second. And the way you kind of have sustainable investing strategies in the public markets is negative screening. I don't want to invest in this, that, or the other. Positive screening, I only want to invest in X. ESG integration, like I said, bringing in ESG into the investment process. And engagement is the other piece, which I just mentioned on the value piece, which is engaging with managements to do this. So let me give you a quick overview on both how private and public markets are thinking about it. These are two cases which I've written for my course. Omidyar Network is Pierre Omidyar, who sold eBay 15 years ago, and basically took all his capital and set up Omidyar Network, which is an impact investing platform. The Rise Fund, which is TPG, was one of the first large funds to really go into impact investing. They initially launched a $2 billion fund, which is now, they raised another fund. And so they've got $5 billion under management, where they intentionally bring impact into the investment equation. So these are the private markets. And this is the Omidyar Network returns continuum. And so on the left side, they say, look, you can actually generate commercial returns. This is the A bucket, and have impact, and you can measure it. But on B and C are like subsidized returns. Either it's pure charity, so there's no return, which is C, or you consciously are sacrificing some return because you think it has massive impact. So a lot of family offices do focus on the B category, which is saying, look, if I want to change the world in something or the other, I will focus on the sub-commercial. I will, if my risk return analysis suggests I should earn 15%, I'll earn 8 or 9, but I think this is going to have massive impact. I'm going to measure it. So there's a whole spectrum, and this, the A piece, only, the fiduciaries can only kind of do A piece. They can't sacrifice returns, but family offices and others like Pierre Omidyar could do B and C. And so they do everything, and they're one of the pioneers in this area. So that's kind of the impact investing strategies, and TPG Rise basically has developed a whole new methodology for impact measurement, which we have. The equally interesting thing is on the public market side, and there's a big debate about, look, if I don't like something, I should divest it, or if I like something, you know, or the other debate is, no, if I divest, then I can't influence the companies for outcomes. And so this big debate is going on in universities, et cetera. So just to make it live, this was Al Gore speaking at, so this is a divestment, pushing it as a 2-minute clip, but at the last Harvard kind of commencement, which happened in person in 2019, and I'll just play this for you.
Fuels can no longer compete. The largest sovereign wealth fund in the world in Norway, financed completely by oil and gas revenues, has started divesting from fossil fuels, and so should Harvard University. That is one of the remaining challenges for this university. I want to make it clear, this is a moral issue. It was immoral to continue investing in apartheid. In the 1980s, when I was in the United States Senate, the student activists of that day at Harvard recruited me to run as one of their candidates, as a candidate for the Board of Overseers, in order to help push the university past its resistance to divest of apartheid stocks and stop supporting that racist system in South Africa. Now, fortunately, the student activists recruited someone else to run with me on that ticket, Archbishop Desmond Tutu, so I did not have to do much heavy lifting. But the university did respond, as they responded when they realized it was immoral to invest in tobacco stocks. Well, let me tell you, the oil companies and the gas and coal companies today have been following the same strategy innovated by the tobacco companies years ago when they decided to undermine the authority of knowledge. They wrote in a famous phrase, and I quote from the tobacco industry documents, "Doubt is our product, since it is the best means of competing with the body of fact that exists in the mind of the general public." The fossil fuel companies adopted the same playbook, the same strategy, hired many of the same PR strategists and technicians.
So that was kind of the divestment thing. I mean, there a lot of people and there are lots of students demonstrating all over the campus, et cetera. But Harvard's kind of management team basically said, look, we're not going to have this blanket divestment strategy. We're going to analyze investments on their financial and ESG metrics, and then make the call. And a lot of people have divested of fossil fuels, but not because, as Vice President Gore was saying, because of the values and the moral issue, but saying that over the long term, a lot of the valuations of these resource firms are based on their reserves, which, given the shift towards renewables, et cetera, are actually not going to be exploited. So therefore, they're overvalued and have significant litigation and legal and mining risk or drilling risk over a period of time, and so they're not good investments. So this debate of whether you should divest or not continues and will continue. The other side of the spectrum is engagement, saying, look, I don't want to divest, but if I think I can, by owning shares, change management behavior, I will. So another two cases which we have, which is CalSTRS, which is the second largest pension plan in the US. It's the California Teachers Plan. And the teachers, as you can imagine, have big issues because of all the shootings that are going on in the US about gun violence. And so rather than divesting of gun stocks and gun distributors like Walmart and Dick's Sports Goods and et cetera, they kind of engaged with them to actually, and they set up what's called the Principles of the Responsible Civilian Firearms Industry. And through the proxy season, et cetera, they've been extensively engaging in trying to change behavior of both the manufacturers and the distributors. Like the manufacturers say, I'm a gun manufacturer. I mean, that's what I do. I mean, if you start me to stop manufacturing guns, then I don't have a business. But how can you make it more safe? How can you make the distribution more safe? How can you basically make sure that the point of sale, the checks and balances that are already in legislation are actually implemented? So a big push in terms of engagement. Another example would be, the State Street created this gender diversity index, which said, there's enough evidence which suggests that having diverse boards and senior management actually leads to better investment decision. So they created this ETF, which is an exchange traded fund, which invests in companies that have a higher percentage of women on their boards and senior management, and created this index which trades right now on the New York Stock Exchange called SHE. And so this again, people then want to get into this index, they start changing their composition. And like I said, over a period of time, diversity creates better value. Just switching gears on the debt side, we talked a little bit about equity. There's a big push on the debt side too. Sustainable debt, last year it was 732 billion issued. Again, it's a small, minuscule percentage right now, but as you can see, green bonds, which are used to invest in green projects, sustainably linked bonds, which link, and I won't get into the technical details here, but the point is that, again, on the debt side, massive increases in new issuance, which are focused on channeling capital to green projects. The biggest issuer of these are USA and some of the European countries. China has become a big issuer. It was zero like 3 or 4 years ago. And just given a lot of y'all are from Asia, it's been a big focus area for China in terms of raising these green bonds and through the banking system, channeling it towards renewables. I mean, I think China and India and other countries will still rely heavily on fossil fuels over time. But I think even in India last year, there was more new capacity in renewables than there was in fossil fuels. So it's going to take time to change it, but there's good momentum. But this just kind of gives you the broader issues, and you can see it's kind of concentrated in North America, India and China, and parts of and Australia and parts of Europe. And so this again just shows you the kind of increase in terms of issuances on the debt side. I mean, keep in mind that the debt markets are much larger than the equity markets. So the more, if lenders basically said to companies, hey, look, if you don't do X, Y, and Z, we're just going to pull your credit line or we'll stop lending to you, it'll just crush the company. So there's a lot of influence that debt holders and lenders can have, just like equity investors. Just a quick case study on NL, which is a big utility in Europe, which has essentially focused on changing its electric generation from fossil fuel-based generation to renewables generation. And to put their money where their mouth is, they issue this bond, which essentially, if you look at the third line, has a penalty that if their renewal capacity does not increase by X amount over the next year or two, they actually pay more on their debt. So they're creating metrics for themselves. This is more of an innovation that happened last year, and we'll see, but there was a huge demand for it. There's also a big shift on businesses and how they're thinking about it. So the Business Roundtable, for the first time, which is a big US and internationally based organization in the US, but a year and a half ago, they issued this thing for the first time that shareholder primacy, while important, is not the only thing. So we need to deliver value to customers, to employees, to suppliers, communities, and then lastly, generate value for shareholders. I think the big next step is, while we can, what are the metrics? And while we can, for the shareholders, talk about share price and dividends, there are metrics being developed for these other four. So it's a little bit work in process, but I think most people realize that if you don't focus on these other four, creating long-term shareholder value is kind of not going to happen. But this is not new. I mean, if I look at I went back and looked at the Johnson & Johnson credo, talks about responsibilities to the world, patients, customers, business partners, employees and communities, and the environment, and then shareholders, just like this. But this was in 1942. So this is not like a new phenomena. It's actually like trying to put it into practice, which is what's changing. So the case for impact investing, I'll stop in 2 minutes, is that there's now more and more evidence it's better investment decisions. There's potentially massive long-term value creation to do this. In the emerging markets particularly, there's a huge customer base. And you look at India, China, there's like, apart from the really bottom of the pyramid and the top, there's a massive, what I would call an aspiring middle class, which is a largely underserved customer base. So creating businesses and investing in businesses which deal with that opportunity, which is multiple billion people, is a huge opportunity. And then this is potentially, there's evidence that this is a no-cost way to live consistent with your values. And that if you create mechanisms, philanthropic and CSR capital on the other side can actually generate better social returns. The concerns, Milton Friedman, the classic thing, which is that the social responsibility of business is to increase its profits and no one should care about anything else. What he doesn't say is over a long period of time. So if you have a long-term time horizon to increase your profits, you do need to focus on those other four parts of the stakeholder equation. The other one is that, look, if you put impact filters and like have impact, will it reduce returns? Multitasking is different. We tell management, look, you've got to focus on financial and impact and ESG and like, where do you prioritize? And then typically people kind of slide towards the profit side. This is somewhat new. And so there's insufficient track record on performance. And then a lot of people are kind of getting on the ESG bandwagon, what we call greenwashing, which is they think, or to kind of get themselves into different ESG indices, they'll kind of massage their numbers to show that they're very green. And so this is another kind of area that we need to deal with to kind of reduce the greenwashing aspects. Just a couple of studies here. Cambridge Associates did a study, which basically the third bullet, from the main bullet, which basically says that IRRs of impact funds maybe a 1% lower than funds for comparable universe. But I still think that there's not enough evidence to really kind of come to firm conclusions on this. And so we just have to see. So that there's a cause for caution, but good evidence initially. On the public market side, though, we've done this study at Harvard, which the green bucket basically shows that you can generate 6% alpha, and this is over 30 years, more than, it's like about 3,000 to 4,000 companies. Basically, if you look at that, if they focus on material ESG issues, so that's a green thing. So the left chart is performance of material ESG issues. For each company, there may be 3 or 4 or 5 things which are important from an ESG standpoint. What's important for a tech company is very different than an energy company, than a consulting company, et cetera. So if you focus on things which are material and performance on immaterial issues, so basically the plus 6% is saying that the companies over a period of time, when they focus on material ESG issues, they've generated a 6% alpha, which is 6% better returns than the market over that period of time. So there's a lot of evidence which suggests if you do this right, essentially you generate better returns. And the last thing I'll lead you is that since you're all AIESECers, you're global in your thinking or and you want to do good to the world because that's such an important part of AIESEC, is that how do you in your investment portfolios and your day-to-day activities integrate impact or values into your investment portfolio? And that's this third dimension of impact, risk, and return. Or, so that's on your investment portfolio, or if you're, looking at charitable giving and things like that, how do you, through different financial mechanisms, increase the effectiveness of philanthropic giving? So I'll stop there. Essentially, this is the train's left the station on this one. The biggest institutional investors, and in our course, we've got cases on BlackRock, Wellington, Blackstone, TPG, the big ones, and then big family offices, and then small funds as well. So the whole spectrum. Is that this is a big area of focus. People believe that they can make money and do good at the same time. And the real issue is, how do we make more progress on it? So let me stop there and I'll hand it back to Gaurav, and happy to take whatever questions you all may have.
Awesome. Thank you so much, Mr. Gandhi. I think that was pretty informative. I think especially the slide on the opportunity on like financial and social investing, or was it return, financial return and social return, and can we bend the curve? I think that was a myth breaker, so to say. So that was pretty interesting as well. But yeah, of course, I'd love to open up the dialogue, open up the chat to anyone who wishes to ask any questions. Feel free to just unmute yourself and ask the questions, or you can put them in the chat box and I'll read them out for you. Either ways. I see one hand up, but I'm not sure who it is. Whoever's hand is, that's Prayog, I think. Okay, go ahead, Prayog.
First of all, thank you so much, sir, for explaining such a multi-layered and a complex topic in a very simple and easy manner. It is very interesting to me. I think I was reading about this, the book Lean Startup by Eric Rice, and his experiment with the long-term stock exchange, where they are not focusing on the stakeholder, but shareholders, but rather focusing on the shareholder value and how companies can look into not just short-term profits, but in terms of a long-term sustainable ESG approach. As a millennial or as a young person, or even as an AIESEC, when how to differentiate between the companies who are just greenwashing and are actually high on an ESG positive impact scale, because we are the ones who will make those buying decisions from these companies, or as an AIESEC, as an organization, we are the ones who will be partnering with these companies. So as far as my knowledge, there is no standard metrics or something to know which companies are doing actually positively well in this. What do you suggest? Do you have some tips to offer? That's my question.
Yeah, so that's this is work in process, Prayog, because creating, like I said, you have constant financial metrics and basically part of it. So there's a combination. So I think three things are in the process of coming together. One is more regulation, where you actually are required to disclose metrics so that they are real numbers which are audited, et cetera. So as I said, for each industry, there's a thing called just like there's FASB globally, which is the Financial Accounting Standards Board, and it's some variant of that in different parts of the world. There's also a thing which some of you all may want to look up if you're interested in this topic, is Sustainability Accounting Standards Board. And so they've gone by industry, by sub-industry, and said, look, these are the 5 or 6 things which matter in each kind of sub-industry. And so there's more regulation going to come that look for this industry, these are the 5 things you need to disclose to your investors. The other is there's a big push from investors to actually get this information. And the third is there's a lot of work being done both academically and otherwise. So like at Harvard, we have this big initiative called the Impact Weighted Accounts Initiative, which takes your financial metrics and then adjusts them based on both positive and negative impact your company may be having on the world. So, people don't price in carbon externalities. So if you actually look at your carbon emission, the best estimate is that basically a ton of carbon should be priced at $80 a share, a ton. And so if somebody who's emitting X amount of carbon basically says you will be charged $80 like a tax, that will actually significantly reduce profitability and change behavior. So I think putting in carbon taxes, et cetera, will be part of the program here. It's already happening in parts of the world. So I think it's a good question. It's hard to answer right now, quite honestly, because I do think the best way to do that is to really look at news searches, look at sustainability reports of these companies. There is some greenwashing that goes on, but like I also say, while people kind of complain and moan and groan about greenwashing, let not perfect be the enemy of the good. So even if there is greenwashing in 10% of the companies, that's fine. 90% you're kind of good. So I think like right now, looking at disclosures and the financials, just the reputational issues, basically news searches, will probably help you kind of identify which companies are more inclined to, like if you look at the natural resources, like that's the biggest kind of target right now is big oil and gas companies. And you'll see that some of the European companies, because Europe is just much more advanced in its thinking on these issues than even the US or Asia. I think the US will change because of Biden, et cetera. But the European, like if you look at Shell, BP, some of the other, like NL, which I said was a utility, they're just far ahead of us to how to think about like channeling capital to renewables, thinking about reducing their new oil and gas exploration. The US companies, there's a lot of green, but they'll set up all these ads, et cetera. But they also then, announce $10 billion of new capital expenditures to drill oil reserves. So there's those kind of things you can actually get good information on, just by doing some basic research.
Okay, awesome. I hope that that answers your question, Prayog. There's a question from Aristo, and I'm just going to read it out to you. Hi, Mr. Vikram. Thanks a lot for sharing the interesting trends of investing to all of us. My question is the ESG similar with value investing with additional metrics of ethics plus moral in the variables?
Yeah, I think there is the ethics and moral. I think that's kind of transcends both the value and the values piece, because ultimately ethics and morals are much more kind of what your values are, because what maybe, while there's some standards as to what kind of ethical lines and moral lines are, there's also a lot of variability as to what individuals think are, fit in with their values and their ethics and their morals, and your values and ethics, while, as I said, there's a baseline, may be very different than mine. And so that's much more of a values thing. I think institutional investors, which have a fiduciary obligation, like I said, like for example, CalSTRS, right? So the teachers, the CalSTRS, the California Teachers Retirement Association, the second largest pension plan in California, they had a huge push by the teachers and others saying our values are that we want to be against guns because we have faced all these shootings in schools, and 70% of the retirees there are women who have a different perspective on guns. And it's California, which is much more of a liberal state than some of like Texas and other places. So there was a big push on that, but the fiduciary person pushed back saying, hey, look, I mean, if I divest everything and there's some good financial returns in investing in Walmart or Dick's or whatever, you guys will be losing out on your pension plan. And so therefore, I would rather engage if I think it's a good, so the first thing is like, is it a good financial investment? And then you incorporate ESG into that. And then I think you can layer morals and ethics. It's just much easier to layer in morals and ethics if it's your own personal money, because you can do whatever you want with it. It's a little tougher to do in the context of fiduciaries. But I think ultimately, there's another course I teach in the MBA program. It's called Leadership and Corporate Accountability. Is that over the long term, if you behave unethically and immorally, you will lose your kind of license to operate in society. And that's happened over and over again in companies. And so while it may not fit in directly into the financial model, behaving ethically and morally over a period of time actually does create significant value. And if you don't behave morally and ethically, you lose your license to operate in society. And that's going to happen much more, like you said, with the millennials, because people will stop buying your products. I know, for example, if I look at the recruiting out of HBS, when I was graduated, no one really kind of even thought about this. Now, the students will, if they're looking at a particular industry, will interview the companies and say, like, what's your climate strategy? What's your ESG strategy? How are you thinking about stakeholder capitalism? And they will actually choose companies to go and work for, which actually fit their perspective. And so that's a big, big shift. And so companies realize that if their customers stop buying their products and no one wants, they're going to lose good talent, they will change behavior. And so I think that's another massive trend. Like we talk about investor influence, to a large extent, customer buying patterns and buying influence and employee kind of push is as important as investors.
Yeah, definitely. I mean, just to add on to, I guess, like the license to operate if you behave unethically. There's some Netflix documentaries as well if people want to have a look on unethical, I guess, operations in society. There is a comment from
on that one. I'll just tell you.
Ahead.
So one of the cases we teach, I mean, it's a really interesting problem, which is Facebook, right? Yeah. I mean, all of you probably are either on Facebook, Instagram, and WhatsApp, and then everyone will blast Facebook for really being bad for society. But all of you are on it, so you're all complicit. Right? So, but no one wants to leave it, but then everyone will criticize it. Oh, you cause riots, you cause lynching, you cause killing, you cause this, you cause that, you cause child addiction, but everyone's on it. So basically what Facebook is struggling is this whole issue of like, what's my license to operate? But at the same time, everybody wants to be part of it. So how do you deal with that issue? Do you deal through regulation? Do people like you basically force the issue, which saying, look, if they've got nearly 2.8 billion subscribers, if 1 billion of them get together and saying, we are going to get off Facebook unless you change X, Y, and Z. I mean, that's a massive movement, but it's not happening yet. But regulation, antitrust, this, that, and the other. But over a period of time, if they lose their license to operate, they think bad things are going to happen. So they're trying to deal with it, but it's an interesting social media, since that's like the new thing for a lot of people.
Yeah,
it is a huge issue from an ESG perspective and a license to operate perspective.
Mm-hmm. Mm-hmm. Okay, I think Hatim has a question, so I'll let Hatim go first, and then I think Yev has a question too.
Thanks, Gaurav, and thank you very much, Vikram. That was a very nice presentation. So since I'm also kind of working in this field, one question that keeps coming back to me is, do you believe that one of the reasons why the space is not growing as fast, or one of the reasons why there's still a lot of questions, is because all reporting eventually has to come back to a monetary metric, which is profit or revenue or something like that. And do you believe that in the long run, there have to be multiple metrics which are non-monetary? Or do you think this can still work if it's just some monetary metric?
A combination, Hatim, of quantitative and qualitative. And part of the reason, like you rightfully say, is that we haven't really figured out consistent qualitative in a way, nearly 70-80%, and you can talk about greenwashing, whatever, but 70-80% of companies out there actually do issue sustainability reports. They do their qualitative assessment. I don't think the metrics are kind of rigorous as they ought to be. But it's, again, like I said, let not perfect be the enemy of the good. It's good progress, not enough, but it's in the right direction. I think the big push right now is that, look, yes, we should have qualitative, but if we don't have quantitative metrics, it'll be very hard for both employees, customers, and investors to really see how you're performing on those. And that's what I said, that I think we will see more potential regulation, both from our regulators, to actually make this more mandatory. I mean, even like in India, SEBI has been talking about how to, they have now the social kind of stock exchange they're talking about, and but just for companies which are on the NSE or other on the regular stock exchanges, is to like potentially having financial disclosure around ESG metrics. So for example, the impact weighted accounts initiative, I mean, they've basically gone industry by industry. So like you take airlines, if you look at the airline profitability, fine, it's X. And maybe the last 12 months has been a disaster, but if you look at it over 5 years, but you can adjust that. If you look at their emissions, the cost of emissions, the cost of what they're doing to the kind of the planet in a way, their profitability plummets. So they're actually putting numbers on it. And so the hope is that the impact measurement project, which is going on globally, impact weighted accounts combined with regulatory requirement. And I think that the problem is that, and that's where I think the regulators and investors kind of need to come together, that there are, if you go on Bloomberg, there are like 750 ESG metrics. Well, first of all, no management can deal with 750 metrics. And for most companies, only 4 or 5 metrics actually matter. But the 4 or 5 will be different, like I said, for different industries, different sub-industries, et cetera, which is why the work on SASB, to the extent you have time or haven't had a look at it, you should spend some time on their website. Really, they've got a sustainability map, which goes by industry sector, subsector. For each sector, what are the 5 or 6 key things along ESG which matter? And then map those to companies. And I think that's the direction we're headed. But I think the reason why it hasn't got momentum is, how can you make decisions when you don't have good information? I think that's kind of the holy grail, if you will. This bright side is, look, it took 100 years for FASB and financial metrics to develop. And people still argue about it, right? They still argue, well, how do you kind of do reserves, or how do you take losses, or how do you value that, or how do you value goodwill, blah, blah, blah. So it's still happening. So I think this will take time, but it's a step in the right direction.
Thanks. Appreciate that.
Awesome. Okay, I think there's a comment from Stella, which I'm going to read out, and then there's a question. So Stella says, thank you, Vikram. You made many points during your presentation. Thank you for giving your inputs in such a synthesized way. Relating to my company, Credo, efforts and targets, I can understand better now how it relates to the global impact. Greenwashing is a new term to me. However, I can see this being a real concern. When companies making the numbers looking better than they actually are, I believe metrics are still to be revised, and world organizations will set control over it. And I think Yev has a question as well. So Yev says, from my perspective, it all starts with the final customer. If a customer chooses only to purchase from sustainable companies and sources, additionally pressure the politicians to make laws that force the businesses to become more sustainable. So his question is, how can each of us help educate people to care more about the environment and social causes, kind of accelerating that progress in this area?
I mean, I think, like I said, it's not just investors or how companies manage. I mean, people are very, very, you'll see change of corporate behavior and how they position themselves based on customer demand. So I think both customers and employees, I mean, ultimately, in any industry, good talent is a big differentiator. And so if you don't get good talent because of the way you operate, you're going to kind of change. I think the way to educate people is really, we're doing a lot through, I mean, social media, getting back to the social media thing. I mean, people get educated both positively and negatively on that. So to the extent we can really leverage social media, and I think a lot of people do, but to the extent you can, I think that would be a huge opportunity. And I think given, I'm not sure where you live yet, but in your local communities, I mean, it's a grassroots movement. It's got to happen in your AIESEC world, or your social world, or your business world, is really kind of do a grassroots thing with a social media overlay. And I think educating, like I said, I think Europe is far advanced on this in terms of their thinking, and the US, North America, and Canada probably too, but the US and other parts of Asia, it's still kind of early days for it. So I don't have any silver bullet on this one, but I think just grassroots, kind of pushing it locally with your your network, and then using social media to push it, in a broader basis.
Yeah, I definitely agree. I think we have, two last questions that we'll take. Stephanie says, thank you very much, Vikram. It's a very important topic because with these investments, we can make an active change. Do you have a recommendation for beginners in which area it would be advantageous to start, I guess, in the social enterprises or green tech world?
So I think it's a broad thing. I mean, I really think you should go drive by what your interests are. There's so much opportunity. Like if you just go by, think about the UN Sustainable Goals thing, and you can just go online and check it out. I mean, they give for all 17 a little more detail, et cetera. Ultimately, my strong belief is that if you have a passion about something, that's where you should channel your energy. And so if you're passionate about climate, I think clean tech, like you say in your question, is a huge opportunity. I mean, I think it's an interesting opportunity because it doesn't lend itself to traditional venture capital because it's got a little bit of longer time horizon, needs more money. So, a lot of longer term funds are being set up. A lot of large corporations are investing in clean tech. And I'm not talking about building new renewables capacity. I'm talking about innovation in clean tech for carbon sequestering, et cetera. So there's no, again, fixed answer for this. I mean, I think whether you look at education, healthcare, financial inclusion, water, climate, poverty alleviation, I mean, just look at the 17. And my suggestion to all of you who are maybe interested is, of the 17 SDGs, just pick one or two which really get you passionate about. Like, I want to help solve that issue. And then build around, in terms of what social enterprises or just any companies kind of are helping deal with that issue, and kind of associate yourselves with them or startups. There are lots of startups. And I would say the other big shift here as a result of COVID, one of the silver linings, even though it's been a disaster, is this acceleration of digitization, right? So what's happened here, I mean, the fact that we're having a Zoom call, just a small kind of microcosm of it, is that what's happened in the last 12 months in terms of digitization of healthcare delivery, education delivery, financial services delivery, you name it, has, like, what would have taken 5 to 10 years has happened in 12 months. And I think that's, in terms of dealing with lower end populations, accelerating the rollout of products and services by using technology and digitization, can be a huge game changer, because it gets one of the biggest problems of delivering these services to the lower ends of the population globally is the last mile problem. And digitization helps deal with that, especially as you get, internet connectivity and smartphones, inexpensive smartphones in the hands of people. So I think that's a massive opportunity going forward.
Awesome. Okay, I think we have one last question before we move on to some housekeeping things. We have some exciting announcements. So wait up after this last question. So Yvonne, I hope I'm saying it right. Yvonne says, thank you, Vikram. Thoroughly enjoyed the talk and solid framework to explore this topic. I'm recently invited to join 2 DE&I boards. One is to close gender equality board, and the other one is to address the special needs of youth with disabilities in Singapore. How do I choose? Because I won't have the bandwidth for both.
Yeah, Yvonne, I think you got to choose as to where your heart is on this one, or your head. Is like, I mean, I may prefer to go with the gender thing. You may think youth and disabilities, and maybe they're equal, but, I think both are seriously important topics. And I mean, again, I think it's a personal decision as to, just go and meditate, close your eyes sometime and think, like, if I had to choose one, which one would it be? Which would get me more excited, which would get a little kind of, give me a little squeeze in my stomach because it makes me more excited. Get my heart rate up because it makes me more excited, and choose that way. I mean, I think both these are really important things. So I think in this one, you really need to go with your passion and your what kind of gets you more stimulated.
Sweet. Awesome. Okay. Yeah, thank you so much, Mr. Gandhi, for that. I think this was really, really informative for all of us. There's some good questions as well. I am going to present 1 or 2 quick things for everyone. 1 second. Yep, so thank you, of course, for coming. Of course, we'd love feedback. If you can give us feedback, so go to bit.ly/AAAP RAT9. So that's AIESEC Alumni Asia Pacific Regional A Talk number 9. So AAAP RAT9. I think Stefan will have put the link in the chat as well, so y'all can have a look and give us feedback over there. We have a couple of announcements, and for the couple of announcements, I'm going to pass it over to David first. So David, over to you to talk about the alumni.
Thank you so much, Gaurav. First of all, thank you so much, Vikram. It's a funny thing, you know, this happened at the last Regional A talk as well. One of the takeaways from Alex was that his description, he felt that the most important word to describe the alumni or the global AIESEC movement was friendships. And tonight's presentation is another example of that. When I reached out to Vikram, who I last saw face-to-face in 1982 at the Coventry Congress when I was PAI and he was there representing India. It meant, you know, a million years later, I could reach out to Vikram and say, please, Vikram, we'd love to have you at a Regional A talk. And of course, Vikram didn't hesitate. No matter how busy he was willing to give us the time. So thank you so much, Vikram. And I'll sort of use this as a bit of a segue as well. You know, one of the things that, for me, one of the takeaways from Vikram's presentation is the importance, he didn't use the word, but for me, it's an important one. If you look at Johnson & Johnson, he referred back to them having built this, inbuilt a recognition of the importance of non-financial parameters, if you like. Well, the fact is, in the alumni community, we're building a culture too. And this is a lifelong global journey. So one of the issues here really is that the alumni is full, AIESECers and the alumni are full of influences. And a way to ensure that many of the takeaways that, that I got, at least from Vikram's talk, it is about making sure that our movement has impact. So some of you will be aware of the little video that we produced over this last month called The Journey. It's been played a little bit. It's now on our YouTube channel. And whereas the working title of our next alumni was going to be Get Real or Get Out, we've stuck with the title of the video, which is The Journey. So you're going to find that on May 29th at 7 p.m., that's Melbourne time, we're going to have a very robust conversation. We'll have a few guest speakers there. Alex, if you're in the room still, I certainly expect you to be there. And there'll be a number of others as well. And this is going to focus on issues raised by the video. So this is about the why of our movement. And for me, part of this is about, you know, is our movement fulfilling its potential? I don't believe it is. If it's not, what do we have to do as a community, as a tribe, as a nation to ensure that it does? So I would strongly recommend that you register for this. I'll ask Stefan, could you please put in the chat both a link to the video and a link to the registration for the event. So we've got the event page already set up. You can register anytime you like from now. And I'd certainly welcome you to do that. And it'll be a safe space for an open and robust conversation. And just so that you know, there are a number of things that are in that video, everything from UN SDGs to Black Lives Matter to all kinds of things. Okay, so that's the first of our 3 announcements. The second is all to do with the mentoring service. So we're basically set to go. There are 3 of us who are going to share just a few thoughts on this with you now, but this is asking you to participate with some opinions, not now, but through a form. So first of all, by way of introduction, as many of you know, AIESEC Alumni Asia Pacific has really been pioneering this whole initiative of developing a much closer alignment with AIESEC, which is why, for me, the phrase I use all the time now is a lifelong global movement. And what's happened is that on a regional basis, the AIESEC regional office has taken us up on the offer of co-managing, co-promoting events for the benefit of both communities. And this is now very much a thing. So tonight's event, for example, the Regional A Talk, is the perfect example of a co-managed, co-promoted event for the benefit of both communities. Another is the AMS. So what you'll find is that the AAAP, so AIESEC Alumni Asia Pacific, has adopted a model developed by AIESEC Life, which is the US alumni organization. And what we're doing over the last couple of months with AIESEC's help is to refine the model, alter dates, survey potential mentees, what have you, to try to make this as relevant as possible for our region. So now, and on that basis, Tony, who's in the room here, and I'll pass it to him in a moment, is representing the AIESEC regional office on the team that will be implementing this across the region. So again, this is now an integral part of the relationship between the alumni and AIESEC. Now, I guess, well, look, I think on that basis, I'll pass it over. I believe it's Stefan who's going to share a little bit more information, and then also Tony. And I would welcome you all then at the end of it to take them up on the invitation to register your expression of interest, whether it's as a mentee or a mentor. Over to you guys.
Okay, thank you, David. So really amazing, also really amazing, like the talk from Vikram about like all the conversation tonight. So we are talking about the topic of alumni mentoring service that is happening in the Asia Pacific region. It's a program that matches alumni mentors with other alumni as well as in AIESECers. So in this current situation, like I represent me and Preo, represent of the regional office in Asia Pacific. We are probably like also really willing to cooperate with this program with AIESEC Alumni Asia Pacific, because we see these have a huge potential to that the youth in Asia Pacific can have more self-discovering, and also to that they know how they can strengthen their leadership after the AIESEC journey, and also how we can collaborate with not collaborate, but even more is like to have more impact to the alumni and also from the AIESECers. So this is the one-to-one mentoring program. Each season will take place over 10 months. In inaugural season will start in for September. It will consist of a minimum of 6 current sessions. And there will be orientation, review, and evaluation events involving all participants at the commencement, the halfway mark, and at the conclusion of the session, awards will be given. So the program is designed to match mentees and mentors across the number of industries based on a variety of criteria, including the skills and experience of mentors and the careers aspiration of the mentees. So we are looking forward for more and more like the AIESEC alumni. If you have your skillful experience and or your like knowledgeable industry background, you would like to share, and even they can become the mentors to support the AIESECers in Asia Pacific. It will be really definitely like great experience for them. So here are now ready to go. So I'll pass to Stefan so then he can elaborate the rest of the process.
Great, thanks guys. So I've just sent a form into the chat, and basically we're ready to seek expressions of interest for the program from prospective mentors in the alumni community. There's no previous experience needed as a mentor, because how we designed the program is that it includes clear guidelines on how the sessions should be conducted, as well as what are the relevant topics that need to be covered efficiently and productively. If you want to express your interest as a mentee as well, that's in the link provided. But official applications for mentors are going to be open in the last week of May, so end of this month. All the information on in terms of timeline and everything is in that form that I just sent in the chat, so please feel free to check it out. Thanks, everyone.
Sweet, awesome. Okay, thank you, Tony, Stefan, and David for your announcements. The last one we have is our next regional A Talk. So just like we had this one, our next regional A Talk is by Teresa Kane, who's super cool. She's also like close friends with David and Vikram as well. So her topic is going to be, if you want to become a consultant, here's how. And it's going to be a very interesting one. That's next month, 13th of June. So you can mark your calendars for that. I guess that's the last of our announcements. Lastly, thank you, everyone. Thank you, Mr. Gandhi. That was amazing. Then we have one last question, I guess, is if people do want to contact you, can they? And if it's fine with you, I'll share your email or something like that with them.
I'm not a big LinkedIn user, but you can do that through LinkedIn and we'll kind of connect by email, or you could send me an email at vgandhi@hbs.edu.
Okay, awesome. So if you guys,
as much as I can.
so if you guys have any other additional questions, or if you want to connect with Mr. Gandhi, you have his email over there. Again, thank you so much, everyone. Thank you for staying beyond the 1 hour that was allocated. Thank you to Mr. Gandhi for waking up on Sunday at 6:30 a.m. and joining our call. Being there for everyone and giving us such
It's been a pleasure for me. Connecting with AIESEC is always a priority, and probably I've been a little remiss in doing that. I'm not as active, and congratulations to David for the initiatives of combining the alumni with AIESEC. I mean, I think it's voluntary, and it kind of takes a lot of extra effort. So well done to everybody, and thank you for having me.
Just so you know, Vikram, just be forewarned, my old friend, that you will expect, I'm sure, a call at some point for when we actually end up having an alumni global event, which includes the topics that you've been talking about. And Gaurav, thank you so much for all your efforts, and same for Stefan and Tony and the rest of the team. So Gaurav, I'll pass it back to you to say goodbye, but can you take a photo of everybody too, please?
Absolutely. So Stefan will help us taking the photo.
Do a nice picture, everybody.
We have Alex here as well. Alex was our speaker in the last regional talk, which was fantastic as well.
Great. So I'm counting down for the picture. So just if you can turn on your cameras, that'll be good. I'll be counting out in 3, 2, 1. Alrighty. All good.
Okay, awesome. Thank you, everyone.
Thank you, everybody.
Good morning, wherever you are in the world.
Thanks, Vikram. Bye, David. Ciao.
Thank you, Alex. Thanks, Michael.
Thanks, Dave.
Take care, Vikram.